Hello, everyone. My name is Ken Leon, Director of Equity Research with CFRA, and I'd like to welcome you to today's webinar, Predictions 2019, CFRA's Best Ideas for the New Year. During today's session, we will hear from CFRA's leading experts as we provide what we think are some of the team's best predictions in 2009 across multiple sectors and sub-industries. Now, before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar questions panel, and we will do our very best to answer as many as we can. Moving on to slide 2. Before we dive into the presentations, I'd like to introduce our panelists. First, Garrett Nelson is a senior equity analyst at CFRA, where he focuses on automotive manufacturers, suppliers, and retailers. Garrett has a BA in economics and a BA in history from the University of Virginia, where he's still a big supporter of their basketball and football teams. Garrett is an experienced equity analyst with years spent at BB&T Capital Markets and Davenport in Richmond, Virginia. Most recently, Garrett was the founder and principal of Commonwealth Capital Solutions, whose focus was to package equity loans for many industries to over 50 lending partners. Chris Kuiper is an equity analyst at CFRA, conducting fundamental analysis and valuation assessments within the consumer finance, capital markets, and REIT areas. Prior to joining CFRA, Chris worked as an analyst for a large cap value fund, and prior to that, worked as a fundamental analyst with Calamus Investments and a credit analyst for TCF Bank. Chris has a Master's of Economics from George Mason, undergraduate degree from Dordt College. And finally, Chris Muir is our senior analyst at CFRA. He is responsible for coverage of stocks in the utility sector and chemical industry, and is also a member of the Portfolio Selection Committee. Chris also held senior industry analyst positions at S&P Global Market Intelligence before that team joined CFRA in October 2016. Prior to CFRA and S&P Global, Chris was on Wall Street as a fixed income analyst at ABN AMRO, and he was also on the #1 utilities team for equities at Prudential and UBS. On to slide 3. So today's agenda, I'll share a bit about CFRA, and then we'll have our panelists cover automotive. Garrett Nelson will cover insights on Tesla, GM's recent plant closure decision, and company capital allocation. Chris Kuiper will cover financial exchanges and data, some very interesting disruptor drivers such as Bitcoin, cryptocurrencies, and more. And then utilities from Chris Muir, very timely with this volatile equity market, with looking at some added inputs on investor activism and M&A, dividend growth for this defensive total return sector, and the California wildfires we've been reading about. We'll follow that up, as I mentioned earlier, about Q&A, and then what's next from CFRA as it relates to January webcast. So about CFRA. CFRA mission is to provide our subscribers with global, independent, and actionable research and analytics to help them make investment and business decisions. With the strength of our quality and depth, we provide differentiated and actionable analysis that helps investors make better investment or business decisions. Our world-class forensic team develops forensic accounting research and analytics that identifies public companies with deteriorating earnings quality. We also supply independent research and commentary focused on stocks, ETFs, mutual funds, sectors, and industries. And we also offer an unmatched suite of independent research solutions. Who are our clients? CFRA is trusted by the most sophisticated global firms. As you can see here on the top, that we are represented in asset managers, 5 of the top 10 firms there, looking across hedge funds, mutual funds, and pension funds. Additionally, we're a world leader in wealth management with wealth managers. We're with 12 of the top 20 top firms, banks, the growing online broker segment, and also other areas. Our research is also made available to regulators, including agencies overseeing private companies, private equity corporations, accounting firms, academics, libraries, insurance and law firms. And our services are used to support multiple investment strategies, as you can see here, from long only to long short, all the way across to diversified portfolios, high-low turnover portfolios, risk management, and alpha preservation. CFRA by the numbers, and speaking not only of our quality and depth, but our scale. And you can see here that CFRA delivers independent research and commentary to help wealth managers and investment advisors to better manage their clients' financial lives, and objectives. 11,500 are covered on quantitative research, and our large equity research team covers on a qualitative basis 1,500 stocks on a global basis. Looking below, you can see that our research also is not only just equity focused, but we covered sectors, industries, both from a top-down and bottom-up perspective. The cross-asset area of ETFs, 1,860 are covered there, and well over 22,000 in mutual funds. And with that, let's go to our program with Garrett Nelson on automotive predictions for 2019. Good morning, Garrett.
Good morning. Thank you, Ken, and thank you to our clients for joining us today. Looking at the automotive industry, we have 10 predictions plus a very bold bonus prediction for you today for 2019. Our first prediction is that Tesla's Model 3 will become the best-selling U.S. passenger car by the end of next year in terms of monthly sales. And we say that because if you look, last quarter, the company sold about 56,000 of these vehicles, which placed it 5th in terms of sales volume among U.S. passenger cars, behind the Toyota Camry, Honda Civic, Toyota Corolla, and Honda Accord, each of which sold between 73,000 and 84,000 vehicles last quarter. The Camry was the best seller at about 84,000. But sales of those vehicles have fallen between about 8 and 13% so far this year, given an ongoing shift in consumer preferences toward the purchase of SUVs and crossover vehicles over sedans, which is a major trend that's occurring in the U.S. auto market. But Tesla is still ramping up their Model 3 volumes. Late last month, they reportedly hit daily output of 1,000 vehicles, which is equates to about 90,000 per quarter. And Model 3 demand is still very strong. We think that will be aided as they introduce lower price versions of the vehicle, eventually introducing a $35,000 model of the Model 3. Moving on to slide 10, we predict better auto equity performance. So it's been a very difficult year in 2018 for this group, which is consumer discretionary, historically a highly cyclical global industry. The 37 auto names that we follow are down an average of 13.5% year to date. And performance has really been hurt by concerns over the new North American trade agreement, NAFTA. The U.S., Canada, and Mexico reached a new trade agreement, the USMCA, in early October, so that's been resolved. The China trade tariffs, which are kind of on hold after this trade truce was declared a few weeks ago. The U.S. and China have until March 1st to work out details of the new trade arrangements, and also rising interest rates and peak demand. And that final one is probably the number one concern from our perspective, because the industry has been highly cyclical, and we're looking at an 8th straight year of growth in global auto sales this year, which is unprecedented in the history of the global auto market. But if you look at valuations, PEs are at or near the low end of their 5 and 10-year historic ranges. So we do think there are some good buying opportunities in the space, but it's certainly going to be more of a stock picker's market in 2019. Our next prediction, we think Fiat Chrysler will be the best performing stock of the Detroit 3 auto manufacturers next year. And this would mark a 3rd straight year of outperformance. Fiat Chrysler has outperformed its peers, General Motors and Ford, by a wide margin. Last year, it's currently the best performing so far in 2018, and we expect that to continue. This company is just in much better shape than either GM or Ford. They have net cash on the balance sheet, about 200 million euros of net cash. They'll be receiving an additional 6 billion euros when they complete the pending sale of one of their divisions called Magneti Marelli, which is expected to close in the first half of 2019. And they'll benefit, we think, from a sales and market share perspective relative to their peers, because they shifted production earlier than either GM or Ford. They shifted their production more toward SUVs and crossover vehicles, the Jeep specifically, where sales have been very strong still, and their new crossover vehicle, the Stelvio, where sales have also been very strong. They just made that shift in their operating plans earlier than the other two auto manufacturers. Our next prediction, we think auto retailers will be the best performing of the 5 major U.S. auto sub-industries next year. And they're being supported by 2 very favorable trends. For one, the U.S. car fleet is at record old levels. So the average car on the road in the U.S. is 11.7 years old. If you look back 15 years ago, the average car age in the U.S. was 9.6 years old. So it's 11.7 is a record high. And also a shift in consumer preferences toward the purchase of used vehicles over new ones. And all those older vehicles on the road sustain demand for maintenance and repair and helps demand for auto parts. So we're positive on the aftermarket auto suppliers, specifically companies such as AutoZone, and more positive on them as opposed to dealerships when looking across the auto retailer space. Our next prediction, we see U.S. auto sales dropping below 17 million vehicles. This would be the first time this has happened since 2014. And what we've seen over the last 4 years is record high U.S. auto sales. This year, it looks like sales are going to come in around flattish, 17.1, 17.2 million vehicles, somewhere in that range. But we expect a streak of north of 17 million vehicles to come to an end next year as interest rates continue to rise, economic growth slows, and the positive impacts of the tax cuts annualize. Our next prediction is that China's auto sales will decline next year. And this is a major development because China has an incredible streak of 28 straight years of growth in auto sales. If you look back to 1990, they were selling well below 1 million vehicles a year. Last year, they sold close to 29 million vehicles. And this year, it looks like China's auto sales will decline for the first time since 1990, down close to 3% year to date through November. So this is a major shift. We think it'll hit the auto suppliers especially hard, which leads into our next prediction. We think The auto suppliers who are over-leveraged are at risk of dividend cuts. We've already seen one dividend elimination. Last month, a auto seating manufacturer, company called Adient, announced that they were eliminating their $1.10 per share annual dividend in order to preserve liquidity and aid in debt reduction efforts. And we think there are several auto suppliers who are over-leveraged at this point in the cycle. If you look, 5 of the 11 auto parts and equipment companies have total debt to cap ratios north of 50% here. And close to 2/3 of the 37 auto companies that we follow currently pay a dividend. We think all of them would prefer not to cut it, of course, but we predict that some will, following in the footsteps of Adient, in the interest of preserving liquidity. It's just going to be a very difficult market, especially with the China contraction. Our next slide, we see a slowdown in stock buybacks and just in general a more cautious approach towards uses of cash as other priorities such as maintaining their dividends, paying down debt, and preserving liquidity becomes much more important in 2019. Slide 17. General Motors made headlines a few weeks ago when they announced that they were closing 5 of their North American plants and laying off up to 14,000 workers. I'm sure everyone saw those headlines. The company is under significant political and union pressures to keep the plants open. We think that CEO Mary Barra will opt to save at least a portion of the jobs by converting some of the plants to the production of more popular vehicles. If you look at the 5 plants that they announced they were closing, those vehicles were really not in high demand. They were smaller sedans, just models which weren't selling well. And a lot of those facilities were operating at one shift, down from 2 or 3 shifts many years ago. So we think that they will bow to political pressure here and announce that they are converting some of those facilities to vehicles which are more in demand with consumers. And then our final prediction of the 10 that we have is that quality matters and that companies with stronger balance sheets and lower leverage ratios will outperform in 2019. We expect to see a flight to quality, more of a risk-off environment in the auto space than we've seen over the past few years. And we think there's going to be renewed investor scrutiny on creditworthiness and liquidity in general, given these concerns regarding peak demand. Finally, our bonus prediction, very bold prediction. We made this our bonus prediction because we see a fairly small probability of this happening, but we do think it would make sense for both companies. We see a small possibility that Apple will look to buy Tesla in 2019. We provided a detailed explanation of this prediction in our report that we published last week. But just to summarize the rationale, why we think it would make sense. For Apple, it would be earnings accretive. They're sitting on $237 billion of cash. Would be an all-cash deal. They could pay all cash. You're looking at probably a purchase price in the range of $100 billion for Tesla if you add a standard 30% takeout premium onto the current enterprise value. It would help them achieve product portfolio diversification. So about 60% of Apple's revenues right now come from sales of iPhones. If you look at their iPhone sales growth, it slowed to just 0.5% in the most recent quarter. And the smartphone industry in general is fairly oversaturated. So it would provide a new and exciting avenue for growth for the company. We know that Apple has a secretive autonomous vehicle project, so it would provide an instant boost to that. There would be meaningful synergies because the two companies are located less than 25 miles from each other in the San Francisco Bay Area. And probably the biggest benefit for Apple is they could introduce the iOS operating system into Tesla vehicles and also gain the addition of a potential successor to CEO Tim Cook, and we would argue a visionary that they haven't had really since the passing of Steve Jobs in 2011, a visionary in Elon Musk. For Tesla, it would greatly help them accelerate their growth and new product development that could open new plants around the world. The issue for Tesla is not demand for their vehicles, it's just capital, and so teaming with Apple would solve that issue immediately. It would provide a payday for Elon Musk, Tesla's largest shareholder. He owns close to 20% of the company. It would also reduce pressure on him. There was the infamous tweet last summer in which he said he was taking Tesla private at $420 a share, and we think he's been, the pressures of being an independent publicly traded company have really weighed on him personally. The biggest hurdles why this wouldn't happen, we think there would be a culture clash. Apple CEO Tim Cook might not be keen on having such an outsized personality at the company, such as Elon Musk. But we argue that if structured properly, with Tesla operating as a quasi-independent subsidiary of Apple, they could work out a suitable arrangement. And likewise, Elon Musk might not be being in a position where he's not ultimately calling the shots at the company. And then the other thing is the acquisition size that I mentioned, in the range of $100 billion would be Apple's largest ever acquisition. Previously, to date, their largest acquisition was the purchase of Beats for only $3 billion back in 2014. So that wraps up our auto predictions. Thank you very much for your time, and I'll send it back to Ken.
Thank you, Garrett. And most interesting, of course, for the global auto trends, but also Tesla. I'm sure we'll get questions on Tesla. Moving next, we're going to talk about financial exchanges and data providers, 2019 predictions. And Chris Kuiper has done quite a bit of work on some interesting new drivers. Good morning, Chris.
Morning, Ken. Thank you. As Ken mentioned, financial exchanges and data providers, it's one sub-industry, a very large industry that I cover. And one of the very interesting things we've witnessed is the intersection of this industry with Bitcoin, cryptocurrencies, and the blockchain technology in general. So our next slide here, we have the price of Bitcoin in US dollars, which has certainly been a headline grabber in 2018, certainly not for good reasons. As you can see, from March 2017 to about the end of 2018, the end of 2017, the price of Bitcoin rose about 1,700% to a high of $19,000 per Bitcoin. And then in 2018, it's crashed 70% in the year, 80% from its high, and it's currently around $3,500. In the next slide, we have a very similar looking chart. So you might think it's another cryptocurrency going up over 2,000% and then declining 60%. Maybe Ethereum, Litecoin, Ripple. But in fact, if we go to the next slide, you will see it is Microsoft 1993 to 2006. So clearly a longer time frame for the dot-com boom and bust compared to Bitcoin. Bitcoin has kind of been the dot-com boom and bust on steroids. But I bring this analogy up as a parallel that I think is applicable, because just as the internet was truly a breakthrough technology that unlocked a lot of wealth, we think the blockchain technology underpinning Bitcoin is also a transformative technology. Never before have you been able to transfer something of value digitally, or in other words, we now have actual digital scarcity. And so just as the dot-com bubble was inflated by euphoric retail investors, Bitcoin has largely gone through the same thing. And for this reason, we wouldn't be surprised to see Bitcoin go down another 50% from here, below $2,000 per Bitcoin. If you remember, during the NASDAQ boom and bust, the NASDAQ index went down nearly 90%, and even stocks like Amazon went down 98% from their high to their low. So another 50% from here wouldn't surprise us. We sometimes forget the math of how something goes down 90%. First it goes down 80%, and then it goes down another 50% from there. So we've gone down 80% from the high, and could go down a lot further. However, if you look at the next slide, we think this price action is a lot of noise, and it's overshadowing some of the stuff that's going on in the background. So on this chart, we have the number of transactions per day performed on the blockchain network. That's the orange bars. And even though they peaked with the price and then came down, from the low of March and April, transactions are up about 70% year to date. And the cost per transaction, that dark blue line, is down 82% in 2018. So the cost of sending Bitcoin is down to about 10 to 18 cents per transaction in US dollars. Not shown on this chart is the number of blockchain wallet addresses or users. That's up 145% this year. And the hash rate, which is a measure of the blockchain network power, is up 168%. So again, we think the price is a lot of noise. It's a lot of bubble activity that we've seen before. But in the background, we continue to see more users, more power, more computers, and more capital flowing into the space. So if we go to our next prediction, that leads me to why I think we're going to start seeing some of the major exchanges offering trading in tokenized assets. To back up one step of where we are now, Bitcoin is one type of token, and we've seen both CME Group and Cboe launch futures on Bitcoin back in December of 2017. These are still obviously very small products for them, but they've been going fairly well. Intercontinental Exchange, they own the New York Stock Exchange. They announced in August of this year a new company called BACKT, B-A-K-K-T. They're also going to start offering Bitcoin futures, but interestingly, they are going to offer a physically settled futures contract, which we think is very significant and interesting. Both CME and Cboe force you to settle in cash, so they don't have to deal with Bitcoin itself. They just get a reference rate that they pull from other exchanges, and they just deal in futures, all of them settled in cash. For ICE to offer physically settled contracts, they're going to have to be able to deliver Bitcoin. They're going to offer warehousing facilities, and they've already secured things like insurance for their crypto storage. NASDAQ originally dismissed the idea, and now they're expected to start getting into the futures game as well early next year. So on the next slide, we get into the tokenization part. What is tokenization? It's the process of converting rights to an asset into a digital token and then putting it on a blockchain. So for example, this can include fungible assets like real estate, diamonds, art, or it could be intangibles like patents. We've actually already seen two examples that I'm aware of, private REITs, where they have tokenized up to 49% of the ownership and then offered those tokens to investors. We saw a student housing project in North Carolina, and then also a ski resort, I believe in Aspen or somewhere in Colorado. Why do we think this is significant? Well, it greatly increases the liquidity of these illiquid assets. Most real estate is held privately, and it's not traded publicly. It increases the access for investors to get into these deals. And then it could greatly enhance or speed up the compliance process. So with a smart contract or token, you could actually program in a lot of compliance features. For example, you could say you have to be an accredited investor, or you can only have so many investors participate, or you have to have a minimum number of investors. That can all be encoded in there rather than having to go through lawyers and paper documents and a lot more expense. And why do we think the major exchanges will get involved? Simply the market opportunity. There's literally hundreds of trillions of dollars tied up in illiquid assets. If you think of not just of land and real estate, but also art, diamonds, collectibles, everything else, major opportunity. And then we think they'll do it through a partnership, not necessarily try to compete. So they'll want to be the place where these tokens are traded, where they already have the trading infrastructure and a lot of the players, but they'll look to partner with other firms to handle the legalities or the logistics of the tokenization process and the compliance process. Our next prediction is the SEC will finally approve a Bitcoin ETF. So the SEC has rejected a lot of proposals in 2018 and even before. Not only the Winklevoss twins who've been trying this for years, but in August of this year, they rejected a batch of 90. And these are from companies you've heard of like ProShares, Direxion, Granite Shares. And the reasons for the rejection, we like to point out, is not because of Bitcoin itself. The SEC has gone out of their way to specifically say, we're not making a value judgment on Bitcoin. We're not saying anything about its use or its value as an investment. We just don't like the infrastructure. We don't think there's enough transparency, or it could be prone to manipulation, or we need to see more surveillance. And for this reason, we don't think there will not be a Bitcoin ETF eventually for any reason. It's only a matter of time before this infrastructure gets built up, and there's a lot of capital already in it, and it's just a time element that needs to work its way through. We already have gold and oil ETFs that use futures, so we already have futures on Bitcoin, so that could be an easy solution as well. And that gets to why we think it's important for exchanges. If the ETFs use futures, this will be a near-term boost for those volumes, such as CME and SIBO. But I think more importantly, longer term, this is just going to continue to validate the space in the asset class. Looking ahead at the exchange landscape in 2019, we've seen a lot of large acquisitions, but we think they will become increasingly scarce. CME made one big one this year for NEX Group for about $5.5 billion. But if you look at the two charts below, these are profit pool charts. And so the horizontal axis is share of revenue. So the width of the bars show the proportionate share of each company's revenue. And then the height of the bars is the operating margin, so how profitable they are. So in 2008, you saw CME and Intercontinental dominating. NASDAQ had a lot of revenue, but was not nearly as profitable. SIBO, very profitable, but a lot smaller. And then you had BATS as an upstart exchange. If you fast forward to today in 2018, it's just a lot more equal. They're more equal in width, and they've come up either in height or come down in height, depending on where they were before. SIBO acquired BATS, and NASDAQ has become a lot more profitable as it's pivoted towards data and analytics. So we think we're going to see more tactical acquisitions to data and analytics. NASDAQ just acquired a data firm called Quandl a few weeks ago. And then 2019 could also be interesting, where we could see the rise of the alternative exchange. So we have the Investors Exchange, IEX. They kind of got their fame in the book Flash Boys by Michael Lewis. They've been struggling with only about 2.5% market share of equity trading, but they recently just got their first official listing from Interactive Brokers. We also have heard and seen some applications from a Silicon Valley upstart called the Long-Term Stock Exchange. This exchange is going to try to align investors' interests with the company for longer-term incentives. One of the more controversial things they've floated is having holders' voting power proportional to how long they've held the stock. So we could see some interesting new developments in 2019 for sure. And kind of spurring this too could be both investor and regulator backlash against some of the major incumbents and how they've been charging for fees and treating certain customers, whether they're high-frequency traders or not. Moving on to the credit rating agencies and the credit field, we think high-yield default rates are going to climb in 2019. We've seen them come up a little bit in 2017. The blue bar is the corporate debt to GDP ratio. That's over 45% now, higher than the last 3 cycles. And while the high-yield default rate has usually moved with this, we have seen a huge divergence. So we think that's definitely going to converge. And if you go to the next slide, this is important because it adds to our overall negative thesis on the rating agencies. So the credit rating agencies have enjoyed a record amount of corporate debt issuance this year, and really since we've had this whole low interest rate regime. This is their single biggest driver of revenue. If you run a correlation to, say, Moody's and the debt issuance and their revenue growth, you get an R squared of over 0.9, which is absolutely incredible for anything in finance. But we think that rising interest rates and then what we see as the rising default rate will start to dampen this corporate debt issuance levels. We think we're at a cyclical high, and then this will then play into these shares and their revenue growth. We think both S&P Global and Moody's Corporation shares are still trading too high given what we expect as a downturn in issuance levels. Now you might say, what about recurring revenues? These companies have a lot of data, analytics, they're increasingly getting into the index business. This is revenue that recurs regardless of the issuance level. And that could help offset some of the revenue decline. But these businesses are actually lower margin than the ratings businesses only because the rating business is such a high margin business for them. So even if they continue to grow it it's then going to offset the revenue, but it's going to weigh on margins instead. And then finally, looking at the data providers, these are companies like FactSet, MSCI, and Thomson Reuters. We think they're all highly levered to both the buy side and the capital markets. Buy side is weakening because of the massive amount of money they've seen flow out to passive strategies. They've been able to offset this just by the capital appreciation they've enjoyed with the 10-year bull market, but that could be coming a pressure here. So we see some hurdles for them. One bright spot or revenue driver for them could be a shift to alternative data. They could either procure this data themselves or acquire it. And alternative data is just kind of become a large catch-all term for any kind of non-public information or information that's not strictly published by the company, information that's not in the 10Ks and Qs. So this could be geolocation data of where people shop, or it could be satellite images, or it could be anonymized data from apps. So apps that glean information from your email and track your email receipts and where you've been spending your money would be an example. As you can see from the chart, this is a big growth driver, and the more these companies can take advantage of this, the better off they'll be. So certainly an interesting year for financial data exchanges and the data providers, and we're looking forward to see what 2019 brings. I'll hand it back to Ken.
Thanks, Chris. And most interesting, and what a difference in 10 years, how dynamic financial exchanges are, and fascinating in terms of the Bitcoin cryptocurrency developments. So on deck is Chris Muir, who will cover utilities predictions for 2019. And given our take on the market and looking at 2019, total return, defensive, dividend orientation, all these are the baseline, and Chris is going to give you that and much more. Good morning, Chris.
Thanks, Ken. Starting off at slide 33, we think weak broader market conditions are going to lead to strength in utility prices in 2019, especially early in the year. This follows a strong year for utilities where the sector total return was 11.5% year to date through December 12th, versus a total return of minus 0.3% for the broader market. The defensive nature of utilities attracts investors during periods of market turmoil. Utility EPS and dividends typically continues to grow steadily even during economic downturns, helped by rate hikes, customer growth, and cost control efforts. Stable earnings growth allows utilities to have much higher dividend payout ratios than the broader market, and to grow dividends faster than EPS in response to market and economic downturns. For these reasons, we think the current utility dividend yield of 3.2% is attractive versus the market's 2.1% yield. Share repurchases are also another way for utilities to use excess cash to reduce share counts, which also helps to boost EPS growth and potentially helps to drive future dividend growth. We also think activist investor interest could help utility stock prices. Moving on to the next slide, we want to talk about the activist investors, but we think they will become more active in utilities in 2019. In 2018, activist investors agreed to take a major equity and preferred equity stake in First Energy after the company agreed to exit its unregulated generation business. That generation business declared bankruptcy, leading to its deconsolidation. We think this provides a clear path forward for the now wholly regulated company. Activist investors also took an interest in Sempra Energy in 2018, seeking a breakup of the company. Subsequently, Sempra announced the sale of its solar business and agreed to add members to its board to form a committee that will seek ways to monetize other non-utility businesses. Looking at 2019, we think activists could target utilities with big unregulated generation or midstream natural gas businesses. Those businesses could be targeted because utility cash flows are often used to support the unregulated subsidiaries, diverting cash flows from what could be used to pay higher dividends. On slide 35, we expect higher electric rates in 2019. Rates in 2018 reflect the earnings neutral pass-through of lower federal taxes to customers, as utilities would otherwise have started earning a higher return than they are allowed. High and rising capital spending levels are contributing to substantial rate-based growth over the next few years and also over the past several years. This has resulted in more frequent and more regular rate case filings. As you can see in the chart, the number of rate cases has increased dramatically since 2000. This, in turn, drives utilities to file rate cases to capture a return on their investment. In some cases, regulators let utilities add riders to the customer bills allow them to earn a more timely return on distribution projects, including system modernization and storm hardening. While allowed ROEs for utilities will likely decline slightly in 2019, we note that rising interest rates could help to support allowed ROEs in future years. Next slide, please. Again, we see rates rising in 2019 after earnings neutral rate cuts in 2018 were related to the federal tax cuts. As you can see in the chart, the growth in customer rates has accelerated through 2017, helped by a rising rate base. As drag from falling allowed ROEs lessens, we think the growth in customer rates will start to benefit. Moving on to slide 37. We note that weather is generally the most important factor to variability in utilities' year-to-year earnings. Consistently hot summer weather over the past decade has driven strong air conditioning related demand and boosted utility EPS in this years. Partly offsetting this benefit has been relatively mild winter weather that lowered electric home heating demand. As we move into 2019, we expect cooler summer weather to be partly offset by colder winter weather. We believe that the cooler summer weather will likely have the largest impact on utilities in the upper Midwest and in the Northeast. Switching to the next slide. We predict increasing investment in renewable energy resources by regulated utilities. Traditionally, most renewable projects have been unregulated, built by independent power producers and private equity firms. We believe that the utilities are responding to the Clean Power Plan proposed under the Obama administration and their belief that future administrations may try to implement similar rules. Individual state renewable mandates are also pushing some utilities down this path. As a result, many utilities are now building regulated solar and wind generation that are being added to the utility rate base. We note that Xcel Energy recently announced that it aims to reduce carbon emissions by 80% from 2005 levels by 2040, and it aims to be carbon-free by 2050. As renewable generation produces electricity intermittently, substantial amounts of energy storage will be required. We see this further increasing the investment needed. We expect additional coal retirements to be announced in 2019, increasing the need for new natural gas and renewable generation in the sector. While new natural gas plants are the #1 choice for utilities, we see them increasingly turning to renewable generation, especially in the wind-rich upper Midwest and the sunny South. On slide 39, we look at capital spending. We see continued high levels of capital expenditures leading to future rate increases. In some cases, utilities are able to add separate charges known as riders to customer bills. Those riders allow utilities to start earning a return on expenditures made in the current year. We see a majority of the capital spending focused on transmission and distribution for system maintenance, storm hardening, upgrades, and expansion. Another major component of the capital spending includes new generation. And due to the low price of natural gas versus coal and other fuels, utilities are building new natural gas plants. On the next slide, we expect the utility sector EPS to grow between 4.5% and 5% in 2019. We've already outlined our expectations that higher customer rates, colder winter weather, partly offset by cooler summer weather, and customer growth will benefit EPS growth. In addition, we also see cost reduction in EPS growth. Finally, we believe that some utilities will make share repurchases with excess cash on hand, further boosting EPS growth. Our mid-single-digit EPS growth expectation is higher than the 3.6% annual growth rate over the past 3 years for the utility index and 4% for the broader index. Switching to slide 41, we expect 2019 dividends to grow between 4.5% and 5.5%. Utility dividends are likely to grow faster than utility EPS as utilities respond to higher interest rates. Utilities have the ability to increase their dividend payout ratios to help boost their dividend yields. We note narrower yield spreads between utilities and the broader market have been driven by relative price changes. But utilities' ability to continue raising dividends through economic and market downturns means that the spread has room to narrow further in our view. Our dividend growth forecast is higher than the 3 and 10-year compound annual dividend growth rates for the utility sector. On the next slide, there have been 2 California utility stocks whose prices were pummeled in 2018 and late 2017. PG&E shares have declined 62% since October 10th, 2017, and Edison International's fell 25%. We chose the October 10th, 2017 date since that's the last day that the stock prices were not affected by the 2017 and 2018 wildfires in our view. Edison International stock fell less due to lower fatality counts and property damage caused by the wildfires in its service territory. PG&E suspended its dividend in late 2017, and we think legislators and lawmakers may be reluctant to provide a bailout that allows the utilities to pay any dividends while cost recovery is being made. That could mean no dividends for well over a decade for PG&E in our view. In addition, yesterday's news indicates that regulators are very concerned about the safety culture at PG&E. We see risks of additional wildfires in 2019. While new law potentially protects the utilities from bankruptcy caused by liabilities from the fires in 2019 and beyond, it doesn't mean that the regulators have to provide for EPS or dividend growth during the recovery periods. On slide 43, you'll observe that much of the state is in a moderate drought, with some areas being worse. While conditions usually improve early and late in the typical year, there has been much slower improvement this year. 1 year ago, 65% of the state was considered to be normal. However, this year, 61% is considered to be in a moderate drought. Another 19% were at worst, either extreme or severe. We see the potential for more wildfires caused by utility equipment next year as conditions appear to be worsening. The extremely large service areas of these utilities makes it hard to check all the utility equipment for tree clearances and for other faults in the service areas. As a result, we continue to see investing in these utilities as being very high risk, and that closes it. So back to Ken.
Okay, thanks, Chris. And certainly questions are coming in. A reminder again that you can submit questions by going to webinar, the questions panel. Garrett, 1 or 2 questions for you, kind of a macro to Tesla. One of the questions that came in was related to why wouldn't there be continued growth with the conversion perhaps from gas to electric, and this may alleviate any slowdown in terms of auto sales, particularly as customers with aging vehicles, strong economy, want to take advantage of the speed of technology upgrades.
So we do think we're either at or close to peak demand for the global auto market, looking at about 100 million vehicles sold this year. We do think consumers will eventually look to trade up to newer cars given the technology upgrades, but we think a lot of consumers, the kinds of technology upgrades that are really going to motivate them to go out and buy a new vehicle are related to autonomous driving. So some lower grade autonomous vehicles are being introduced, so what we call level 1 and level 2, but we still think we're about a decade away from level 5 fully autonomous vehicles being introduced to the marketplace. There's a lot of regulatory issues that need to be worked out, insurance-related issues. So that's going to take some time. But when we refer to peak demand, we're referring to the 8 straight years of unprecedented growth in global auto sales, and peak demand for this for this cycle.
So obviously a courageous prediction on largest auto sales from the Model 3, the bull case, and questions come in, in terms of what the thinking is of the bear case and whether Tesla is going to face increased competition very soon, whether it's luxury or mainstream manufacturers. What's your opinion of that? And also, please, what is your recommendation and target price on the stock?
So we have a buy rating and $420 price target on Tesla, which we raised a couple weeks ago from $375. We actually didn't turn positive on the stock until after their third quarter earnings release, which was really an inflection point for the company. And the reason is they finally demonstrated operating leverage. So auto manufacturing is an inherently high fixed cost business, and their Model 3 sales jumped from about 18,000 vehicles in the second quarter to 56,000 vehicles in the third quarter. So their sales of that vehicle, which accounts for 2/3 of their total auto sales, tripled on a sequential basis. And as a result, their cost of sales per vehicle fell by close to $10,000 from the second quarter to third quarter. And they're still ramping up. As I mentioned, they reportedly hit a production rate of 90,000 vehicles per quarter in late November. So we're very positive on Tesla looking out. And if you look at our estimates, 2018 was really a tale of two years for them. They lost over $3 a share in the first two quarters. They swung to a profit of $2.90, which is about $11.60 annualized. And we think their earnings will continue to increase as they increase volumes, continue to drive the unit costs down. And so our full year estimate is a loss of 30 cents. Basically, the losses of the first half of the year canceling out the profit from the second half. But in 2019, we see earnings of $13.25, which we actually think could prove conservative. And then in 2020, we see earnings of $18.75. We just can't think of another company in the market that has that kind of two-year earnings growth expectation. And looking at 2020 and beyond, we argue the stock is still very inexpensive from a valuation standpoint, trading at less than 20 times 2020 earnings. And then to answer the other part of your question related to electric vehicles, they will see increased competition. But if you look at the models that are being introduced in 2019, all the electric models, the vast majority are either SUV crossover vehicles or really high-end sport cars, with most of which have a price tag of over $100,000. So we think Tesla's in a really favorable position, especially as they introduce these lower-priced Model 3s. We also think they have a significant first-mover advantage in terms of technology. Their electric range, the single-charge range, is far superior to any vehicle that will be coming out next year at least. And also, this vehicle, its 0 to 60 acceleration of the Model 3 is about 3 seconds. For the Model S, it's just over 2 seconds. Is the 0 to 6. So it's a superior product. Consumers want Tesla products. They have significant brand value. And also the Model 3 was given the highest ever government safety crash test rating of any vehicle ever tested.
Okay, great.
So
I'm going to move to Chris Kuiper. And Chris, interesting on high yield debt, particularly high yield debt defaults, and whether it has some impact on floating rate defaults as well.
Yeah, we certainly think there's going to be a spillover. These things tend to move together. Just as a little background, the increase in high yield defaults, I showed the chart where we think it's going to converge just like it has in the past and move along with the corporate debt to GDP ratio. And if you kind of get under the hood of what will drive the actual defaults, I think it's really going to be just a downturn in profit margins. We've had record high profit margins, and the risk of them turning down will probably be due to cost pressures from labor and materials, which we've been seeing. And then as the Fed continues to raise rates, although there's some question of a pause even at these higher levels, companies that took out debt at very, very low rates are going to start having to refinance at higher and higher rates, which is also going to squeeze margins. So we'll see it from both sides, the high yield default and in the floating rate debt market as well.
And a related question, Chris, is there anything episodic? You know, it's not 2009 or 2010, but for the high yield market, is there anything either by industry profile or maturity or floating or fixed that you're going to be tracking just so you can share it with all of us?
Certainly, yeah. I'm not trying to sidestep the question, but sometimes I think that question is a little bit like what snowflake causes the avalanche, right? It's not necessarily one thing. The journalists of the market like to point to the one event that causes something, but it's really all these levels and these imbalances building. So just the fact that we have over 45% corporate debt to GDP, that's something that's building. However, I do think it's interesting to look at, we have a record amount of BBB rated debt, so debt just above junk. It seems odd to me that we magically have just so many companies that are right on the cusp, and it could be, but if anything proves to be like the past, a lot of these BBBs, we're going to find out they're not BBB. And the other thing that I'm tracking too is just the amount of covenant light loans that have been issued is at record highs as well. So you start to get into companies that maybe should have had more covenants on them. So those are the things I'm watching there.
Okay, utilities. Chris Muir, California, made some good calls. Where are you on your recommendations on PG&E and Edison International, and what effect does this have on Sempra Energy?
Well, PG&E and Edison International, I have to sell on both companies, basically until the wildfire risk gets sorted out. I don't believe that these companies are going to go anywhere. There's additional risk for PG&E with the big wildfires in 2018 that have just occurred. I would sell the companies if you have them in your portfolios. I think steer clear of these companies. There's a lot of other utilities that are going to treat you a lot better. With regards to Sempra Energy, they also face the same potential inverse condemnation risk that the other companies have. We note, though, that they haven't had any major wildfires in their service areas caused by their utility equipment in many years. They had one wildfire-related incident back in 2004 where they were not able to recover the cost of that because their equipment was deemed to be at fault. But I also look at Sempra Energy. It has large non-regulated businesses still. Even with the sale of its renewables business, it still owns the big midstream business for the natural gas export and import, as well as pipelines. And I think Sempra is a better bet for the California utilities.
Okay, Garrett, last one on auto vehicle sales outlook, price of oil. So related to what price of oil would we see a reversion back to more cars versus SUVs? And what is your expectation of where oil will be in 2019?
So what we can say is that the steep drop in oil prices over the last few months have really helped vehicle sales. So 2 or 3 months ago, we were looking like U.S. auto sales were going to be down about 1.5% to 2% for the full year. Now we're looking at flattish, probably up slightly. And so we think that the drop in oil price has really helped provide a short-term boost to auto sales, combined with expectations that interest rates, or fears rather, in the eyes of consumers that interest rates are going to continue to rise. So they're, making those purchases sooner than they would otherwise. And then related to SUVs and crossovers, we think that the real change here that's occurred over the last several years is you have much improved gas mileage per gallon for those vehicles. And that's been a big reason why there's been a shift from consumers not buying as many compact vehicles, not buying as many sedans as they were previously. It's just the gas mileage on a lot of the newer SUV and crossover models has improved significantly.
So one last one for you, Gary. There's been several questions from Tesla, but this was a kind of an interesting one because they are a producer of battery storage. So when would you think it would be visible to investors in terms of solar and wind energy as new revenue streams, or perhaps where it could be captured with that added value in the share price?
Yeah, that's a good question. So our valuation basically ascribes no value to the energy, the solar business. If you look, that segment comprises only about 6% of their revenues because the auto sales have grown so significantly, has really shrunk the contribution of the solar and energy business. So we do think there is value there longer term. We're not really giving them any value though in our $420 price target.
Great. Thank you all for questions coming in and to our presenters. Before wrapping up, I want to make note of upcoming CFRA webinars. On January 9th will be It Is Time to Buy or Bail, Adjusting to a Low Growth Environment, and that will be from our equity strategy team. And then on January 14th will be the Payments Revolution, Winners and Losers as the World Goes Digital, and that will be from our leading industry analysts. There will be links to register for these sessions, which will be sent to you later today, along with the recording and slides for today's sessions. In the meantime, please check out our CFRA's Market Scope Advisor for our latest research, and also our other 20 indications in the Thematic Research tab. At any time, should you have any questions, please do not hesitate to contact us at cservices@cfraresearch.com. So I want to thank you for joining us today, wishing you and your family a happy holiday and a happy new year. Take care.